You've set your trade, your analysis looks perfect, and you're waiting for the bounce. But instead, price dips just far enough to hit your stop loss before immediately rocketing in the exact direction you predicted. This frustration usually comes from relying on a single perfectly drawn horizontal line for support and resistance. Expecting the market to perfectly obey an exact price point is a retail illusion. To fix this, we need to upgrade our charts. We are going to replace those thin lines with thin supply and demand zones, which track where the big money actually operates. Before we map these out, pull up your preferred charting platform and pick an asset class to analyze, whether it's crypto assets, Forex currency pairs, or traditional stocks. By shifting focus from exact lines to these wider zones, your charts begin to reflect the same regions used by major financial institutions to manage their positions. Large banks and hedge funds manage too much capital to execute their trades at a single penny. They have to maneuver substantial block orders across a wider general price area. This chart shows a wider demand zone at the trend's bottom, where institutions see value. Inside, big money opens longs and closes shorts, creating double action pushing price vertically. Panning up, the supply zone shows the inverse. Longs close, shorts open, triggering aggressive sell-offs. Because everyday retail traders cannot move markets, accurately drawing thick zones is the only way to track institutional volume and catch moves safely. A common mistake is trying to map these zones on a 15-minute intraday chart. Those lower timeframes are filled with erratic market noise. Institutional capital shifts don't happen based on minor 5-minute price fluctuations. Go into your settings right now and zoom out to a macro view. You want to look exclusively at the weekly or monthly timeframes to find your setups. Look at this macro timeline chart. Notice how this wide supply zone was established years ago on the far left. As we stretch it horizontally, it perfectly intersects with a present-day price peak to trigger a clean reversal. Mapping higher timeframe zones ensures you have a significantly higher probability of catching true long-distance reversals. When price finally reaches one of these wide macro zones, it rarely reverses the exact second it touches the boundary. Instead, you'll often see the price chop sideways. Think of liquidity like a small pool. If massive institutions dumped all buy orders into the market at once, prices would instantly skyrocket, preventing them from filling their remaining block orders. To avoid this, big buyers operate gradually. They spread out their purchases over time at demand zones in a process known as accumulation. Inside a demand zone, this process often takes a specific shape. Watch how the sideways price action gets squeezed between these converging trend lines, forming a falling wedge before breaking upward. The same logic applies to supply zones. Institutions slowly offload their assets in a process called distribution, which typically forms an ascending triangle pattern on your chart. This sideways chop within a macro zone reveals institutions loading their positions, signaling an impending breakout. Because these zones are highly visible, entering trades the moment price touches the boundary is risky. You run straight into the primary threat, the false breakout. Often, price dips slightly past the boundaries of a zone. This tricks impatient retail traders into jumping in the wrong direction right before the reversal. Your best defense is patience. Drop down to a lower intraday timeframe, like a 1-hour chart, to watch this trap unfold from a safe distance. On the left daily chart, we see the false breakdown. On the right 1-hour chart, price reverses back inside the zone, breaking the downward structural trend line. Hitting the trapped trader's stop losses creates a cascading vertical spike, providing confirmation for a safe entry. True mastery requires this two-step process, using higher timeframe zones to find the battlefield and lower timeframe confirmations to avoid the traps. Look at your workspace now. You've cleared out the messy, unreliable thin lines and replaced them with clean, high-probability institutional zones. By mapping these specific areas, you are operating based on actual market psychology rather than hoping arbitrary numbers will hold. What we've covered here is only the foundation. Professional trade management and execution goes much deeper. To get access to advanced entry strategies, click the link in the description to download this free zone mapping template and trading guide. If you found this helpful, hit the like button, subscribe, and turn on notifications so you can continue mastering the strategies of smart money. See you in the next one.